Hi everyone, it's Alex here at Sestrin Capital Research. Welcome to our Tech Select webinar. This is a weekly event that's normally for our pro tier members only, but life is good, and so this week we're opening this to anyone who chose to join us. So welcome all. We've got many people joining us today. That's great. Lots joining live, and plenty will be watching the recording as well. So thanks for joining us. Agenda today, and we'll take between half an hour and an hour, depending on how things go. Is to run through a couple of things. So first of all, outlook on the Nasdaq. So Nasdaq's been on fire this year, as you know, since the start of 2023, and the question is, how much further can it run? We'll look at this is a volatile week. So we had the CPI print today, which, as I'm sure you're aware, came in a little bit warmer than expected. Market reaction muted. Nasdaq up, S&P flat, Russell down a bit, but no great reaction really, at least not today. We have on Friday options expiry, which is a big deal and is usually a cue for lots of volatility. So we'll explore that, talk about what that is and why it causes such volatility. And then I want to go through three high growth tech stocks that have certainly started to move up this year, but really didn't get the memo about the bull market in 2023, and we think can move up for the rest of the year and through next year. Now, as you will know, if you're a pro tier member and you join here often, we run all of our webinars on a live and open mic basis. So if anyone has any questions, points, comments, anything you agree with, disagree with, anything at all, just open your mic and shout out loud, and we can deal with questions and comments that way. If you're not talking, go on mute if you can, just so everyone's audio is uncompromised. And if you want to post a question, but for any reason you can't use audio, then use either the chat functions or the question functions right here in the system. There's a couple of people not on mute. If you can mute, that'd be great. Thank you. Okay, before we do anything else, let's do our disclaimer. It's on your screen right now. So disclaimer, this webinar is intended for US recipients only, and in particular is not directed at nor intended to be relied upon by any UK recipients. Any information or analysis in the webinar is not an offer to sell or the solicitation of an offer to buy any securities. Nothing in the webinar is intended to be investment advice, nor should it be relied upon to make investment decisions. Sestrin Capital Research, its employees, agents, or affiliates, including the presenter of this webinar or related persons, may have a position in any stock, securities, or financial instruments referenced in the webinar. Any opinions, analyses, or probabilities expressed in the webinar are those of the presenter as of the webinar's date of transmission and are subject to change without notice. Companies referenced in the webinar or their employees or affiliates may be customers of Sestrin Capital Research. Sestrin Capital Research values both its independence and transparency and does not believe this presents a material potential conflict of interest or impacts the content of its research or publications. Okay, so let's get going. Let's look at the Nasdaq. So let's look briefly at an overview of where it's been. Tom, I think you're not on mute. If you could mute, that'd be great. Thank you. Okay. So the first question, if you're going to run a chart of anything, you have to pick your start point, and it doesn't matter, what your charting method is, be it the Elliott wave and Fibonacci method that we use, be it some other form of charting, doesn't matter. The common thing is you have to pick where you're going to start and where you're measuring from, and that pretty much determines what your forecast looks like. Now, for a couple of years now, we've been using the 2018 market low as the start point. And the reason for that is because monetary supply, federal policy drives everything, via various channels. And that particular money spigot was opened at the end of 2018. So I just want to look at the Nasdaq chart and see why we use that and what we've been projecting and why, and then look at why that might be wrong. So let's switch to that now. Just going to switch screen. Still someone not unmuted. If you can mute, please, folks, that would help. Okay, so this is the QQQ you see before you. This is the ETF that tracks the Nasdaq 100, as you will know, and we can use this as a good proxy for the Nasdaq. So in our work, we use the Elliott wave and Fibonacci technical analysis method. There's lots of technical analysis methods. They can all work if you're skillful with them. I don't think there's any one that's particularly better than the other. We like this, we do well with this, why we use it. And if you're not familiar, Practitioners like to make it sound very complicated. Isn't really. Elliott waves are the notion that stocks move in ebbs and flows, and in the dominant direction, which at the moment we're in a bull market, so that's up. The dominant flows tend to move 1 up, 2 down, 3 up, 4 down, 5 up. And then in a corrective counter trend move, they tend to move in 3 waves: an A down, a B up, a C down. Not so difficult to understand. And you can apply that method over various time frames: minutes, hours, weeks, months, years. And people will tell you that they're perfectly fractal based. They're not really, but the method works somewhat, and it works somewhat not because of any deep insight into psychology or anything to do with the golden ratio that we'll talk about in a moment. It works because large account practitioners, the folks who move markets, use this method to determine where they think cycles will peak and trough. And so if you use the wave method, you're speaking the language of large accounts, and that's why it works. It's simple. We overlay on these Elliott waves Fibonacci retracements, which is a move down in the case of a bull market, and extensions, which is a move up. So on this chart, the red ladders you see are measuring moves down, and the green ladders are measuring moves up, and measuring is the key point. So a wave is somewhat qualitative in nature, doesn't necessarily have to be bound by numbers. It's an up, down, up cycle. The way we measure the amplitude of the waves, the moves from the low to the high points and back again, is using these Fibonacci retracements and extensions. And again, it sounds complicated and you can get into great levels of detail about why it works, but the real reason it works, again, is because large account players use this as a language. It's a method by which they manage money. So if you can get skilled at it, then you can have some insight into where securities will peak and trough and where they'll turn. Nothing's perfect, obviously, but you can have some insight into it. That's why we like to use it. Now, back to that start of the cycle. So here's the Nasdaq at the end of 2018. 2018 was a really important year. It was initially a bullish year, but the Federal Reserve began to tighten monetary policy. In other words, raise the cost of money and reduce the supply of money. Did that mid-year. And the intent was to normalize the post-2009 QE era. Now remember, this is before COVID, before any of that. And the feeling at the Fed was that the economy had been spoon-fed for too long and things needed to get back to the pre-financial crisis times. Well, that proved unpopular with most everybody, market participants, the incumbent administration, and many others. And so what happened was the Fed reversed policy. And you'll find many reasons for why, but in essence, there was pressure from the incumbent administration to change course. And that's not a political statement, it's a fact, it's what happens. All administrations apply pressure to the apparently independent Fed and other central banks around the world, just the way it is. So what happened was at the end of 2018, the market really sank into a hole. And December 18, for those of you who were investing or trading then, was a pretty miserable time if you were hoping for the market to go up. There's a sharp bounce at the end of 18, and that's because the Fed reversed course and started loosening monetary policy. In other words, reducing the cost of money and increasing the supply. And the result of that was that securities, the Nasdaq particularly, ran up during 2019. So the QQQ moved up from $143 a share at the end of 2018 up to around $237 by February 2020. So a huge move up in only a little over a year. That's a wave one. What happened next, as you know, COVID crisis comes along. Everyone's very worried about the state of the economy. Shares sell off hard. And the Nasdaq retraced in the lingo, or gave up, dropped down to, in Fibonacci world, the 78.6 retracement. What that means is that about 80% of the value gained since the end of 2018 to that February 20 peak was surrendered in just a month. So that's a wave two down. Waves two tend to be sharp drops. And again, there's many different technical analysis methods. This isn't any kind of, miracle or guru method, nothing like that. There's many that work, but this is a way that we've found successful for us. This is a wave two drop, sharp drop, 78.6% retracement, and a real V-shaped recovery down here. There's two reasons for that. wanted to do with options expiring. We'll talk about that later. But the primary reason for the sustained move up, as you know, is a flood of federal liquidity. So again, exceptionally cheap money and a wall of it, a tsunami of it. And that propels all stocks, but particularly growth stocks and the Nasdaq up. And we get a big wave 3 up. Waves 3 in this world are always substantial. A very common place for them to get to is the 1.618 extension of this wave 1. The Nasdaq in 2021 at the end of the year peaked at the 2.618 extension of this wave 1, a huge wave 3. And to understand what that means, it's just a measurement. So you take the length of the wave 1, so that's about $90 a share ish, from 143 to 237. You multiply that by 2.618 and you add that number to that wave 2 low, and there's your wave 3 peak. What happens then, as you know, is Fed reverses course again. Federal Reserve becomes belatedly worried about inflation and turns the tap off again. So money becomes more expensive and there's less of it. And we get a wave 4 down. And this is a classically beautiful wave 4 down, a 61.8 retrace of the wave 3 up. In other words, it gives up about 60% of the value achieved between March 2020 and the end of 2021, and drops all that over the course of about 10 months. And this 258 level proves really solid support on the QQQ. It's tested several times from October through to January, never really punches lower than that. And in truth, if you were watching this at the time, even if you had called a low earlier in 2022, as we did, by the time it got here, that was a rock solid low. And so it was clear to be buying growth stocks around here. So for those of you who are subscribers to our various services, you would have seen us call buy on the Nasdaq and a slew of tech stocks, all of which have done incredibly well this year down here. Now, we're now in a wave 5 up, and wave 5s are the final move up in the cycle. And wave 5s typically, just on a pattern recognition basis, finish somewhere between 61.8 and 78.6 extension of the waves 1 to 3 combined. Again, sounds complicated. It isn't. You take the share price movement from the bottom of the wave 1, 143, to the top of wave 3, 411, subtract 143 from 411, multiply by 0.618, add that number to the wave 4 low price, and there you go. There's your 61.8 extension. And the point is that wave 5s tend to finish somewhere in this zone here. And so if this chart is correct, if in fact the 2018 low is the right place to start this cycle, and it looks good, right? Because if you're familiar with waves and Fibonacci's, this is a textbook chart. It's reality, but you could teach this in chart school. It's a thing of great beauty. So there's every chance it's right. And if that's the case, please go on mute, folks, if you're not on mute. If that's the case, then we would expect to see the QQQ peaking somewhere between 420 and 460 before rolling over and selling off pretty hard at that point. So yeah, these things don't work so well on the x-axis with time as they do on the y-axis value, but that might be, in the next year or so, let's say. Okay, so far so good. The only trouble is I don't know if it feels to you like the Nasdaq is going to fall over anytime soon, but it doesn't feel that way to us. And so let's just look at some facts as to why this chart might be wrong and why, in fact, we might be in a more bullish environment than we think. So let's flip back to some slides for a moment. Okay, so we've looked at a chart that starts at those 2018 lows, and we've said if that was correct, and we would expect to see the QQQ top out in the 450, 460 range, something like that. And then unwritten in this slide is, and then sell off hard, because that's what happens at the end of a wave 5. But let's take a step back. Charts are good, but it's good to look at reality as well and try and reconcile the two. If you can reconcile reality and charts and the two things tie up, well, then your analysis is probably pretty good. What's hard to reconcile to that chart? That chart says that the Nasdaq will soon top out and roll over. Is this number one? CPI popped up a little bit today, but the longer term trend is down, and it's falling in the US. The rate of inflation is falling in the US faster than most other large economies. The other thing in the US is the central interest rate is now higher than the CPI rate, and that's unusual. That's also true in China, but probably for different reasons. In most other major economies around the world, the interest rate remains lower than the inflation rate. And so if you see the Fed criticized for having tightened too fast, that might be true, but that's only because they didn't tighten soon enough back in 21. Actually, at the moment, you would say they've ended up with a lower inflation rate. You can argue all day as to whether the Fed actually delivered that or not, what's cause and effect. But as a matter of fact, rates are higher in the US than is the CPI. And that's not true in most other places. And what that tells you is probably the Fed's going to have to cut rates because it's not really sustainable to have base rates higher than the rate of inflation for too long. The other thing, if you look on a fiscal perspective, GDP, really strong growth in the US, jobs growth, job creation is good. And then if you drill down into lots of the tech stocks we cover, and I don't mean tiny businesses, I mean things like Microsoft, growth is accelerating. So Microsoft quarterly growth rates dropped down to about 2% 2-3 quarters ago, and they then ticked up to 7 and now 8%. And so you have a company with, something like $200 billion of annual revenue growing at 8% a year. Now, that's quite remarkable if you think about it. And so you'd have to say, okay, inflation's coming down, rates are probably going to get cut, GDP looks good, jobs look good, consumer wealth that was reported today or this week in the US has never been higher, and growth's accelerating in some of the biggest companies in the world. So does that look like the market's going to roll over in a few months or a year? And my answer is no, it doesn't. Now, of course, anything can happen, and charts have a funny way of forecasting things. There could be a macro event, there could be a China-Taiwan thing, there could be a the much wanted credit event that everyone likes to talk about on Twitter. Who knows? But it warrants at least looking again at this forecast that we've made. So let's go back to the chart and let's say, well, what if the chart's wrong? What if we should be more bullish? And what does that tell us about where the Nasdaq's going? And that's really important to work out, because where the Nasdaq is going sets the backdrop for what about all the individual tech stocks. So let's go back and look at that chart. Okay, so we just ran this chart starting at the 2018 lows. Very interesting. But what if, in fact, the low should be the COVID lows, the COVID crisis low? Let's clean this chart up and let's look at this. Well, let's see how this would look in this system. Well, it's pretty good. So here's your start of your wave one down here. So the Nasdaq QQQ drops to around 165 in March, and it bounces sharply out of there as we've discussed, and it moves up to about 411 right at the end of 2021. It tries to push up over that, fails over the course of several weeks, and then gives up the ghost and falls pretty quickly. So there's your wave one up. Now the thing about this move down here in 22 is the move down was surprising in its extent to many people, not least us. So we called the top here pretty good, and we thought that the Nasdaq might fall to 316, which would be the 38.2 retrace, and if it's a wave 4, that's a not uncommon retrace. Plunged straight through that. We thought it might hold at 287, didn't, plunge straight through that. And by the time it got down here, we were really confident it would hold, and we started buying in personal accounts here and calling, screaming buys in many stocks, Nvidia, MDB, Microsoft, a whole bunch of things, Marvell, and many others that have done very, very well. This looks like a wave 2. And the reason it looks like a wave 2 is waves 2 generally trough somewhere between the 61.8 and the 78.6 retrace. They can be lower for sure, and they can be higher, but that's a common retracement zone. So this, let's color this in red here, this sort of zone here is very often where you'll see a wave 2 trough. And so if this is where the world in this current cycle started, this could well be a wave 2 low. Now let's think about what happened at the bottom of COVID. A lot has changed in the world. So we had a completely new federal money environment, as we know. Federal money environment changed fundamentally at the top of this wave 1 high as well. It got slammed into reverse, and a new inflation environment took hold during 2022. Lots of things happened in tech as well. So lots of trends that were already underway, which is to say the shift of more and more industries and functions online, the shift to more and more distributed working, the shift to more and more distributed application development, the acceleration of cybersecurity matters, a whole bunch of things that were happening anyway got accelerated. And not just for that brief, everyone's locked down at home and can't leave the house sort of thing, but those things have persisted. Behavioral changes have persisted. So you have even relatively young people who are at lower risk of any particular COVID variant remain not all that keen to come into the office. And, some of that for some people is a medical concern, and some of it is just a change in expectations of the workplace. So something in the world changed and kept persistent from March 2020. So it's possible that that was a low, and this was a wave 1 high, and that's a wave 2 low. Now, why this matters is because, look, if what we're in now is a wave 3 and not a wave 5, then I can tell you that the QQQ is not going to stop between the 420 and the 460 that it will do if we're in a wave 5. It's going to stop at probably not less than 650. Why? Because that's the 1.618 extension of this wave 1 up placed at the wave 2 low, which is just standard Elliott wave Fibonacci extensions. And it's not, if you're familiar with this system, you'll know that there's nothing controversial about calling that as a target. These are common extensions. It looks like a big number, but wave 3s always do. And you would have to say as well that all this year, the Nasdaq has felt unstoppable and still does. CPI comes in a bit hot today and the Nasdaq's up 0.5 point. That's not what would have happened in 2022. So if this is a wave 3, and increasingly we think it could well be, then we're not going to see the QQQ top out here. We're going to see it start to think about topping out here, and maybe a lot higher, but let's say here for now. And let's start to think about 650 on the QQQ as a target. Well, that's not far off a double from now, and I'm not sure that many market participants are expecting that. And if that does happen, think about how many people have been taken by surprise by the strength of the market this year, not just the Nasdaq, but also the S&P and also the Dow. The Russell's been a bit weaker with the financials impact, although we think that's going to start to pick up now as well. But the S&P, the Nasdaq, the Dow have all surprised many people to the upside. So our work here is really focused on looking at what happens when the QQQ gets to this 420, 460 zone. So between now and then, it doesn't matter. Wave 5, wave 3, doesn't matter. It's all the same. But in our research work and the ideas we publish, and also, frankly, in staff personal accounts, where the Nasdaq rolls over matters a lot, because if that's right, this is a wave 5 we're in right now, and we're going to peak in this 420 to 460 level. Well, it will be smart to start taking some profits around here and start to think about taking short positions on the way down. Do that in a wave 3, and that's a recipe to, at best, miss out on a lot of profits that could be made, or if going short, really, really, really incur some heavy losses. So this is a question that I think we're going to need to answer within the next few months, and it's something we do all day, every day, quietly here in work, and we publish pieces of this analysis as we go in Tech Select. You see it in the Market Insights Substack as well, and we cover it extensively in our Inner Circle service. So that's the Nasdaq. Now let's move on a little bit. Before we do, if anyone has any questions, points, comments, anything at all, now's a great time. I've got one question here. Okay, Tom, you say you can see me, but no charts. Okay, if anyone else has that problem, please do let me know. I'm just going to type this in chat now. Okay, anyone else can't see the shared screens, please do let me know. Okay, so if no other questions at all, then let's move on. So I go back to our presentation here. Okay. Okay, so let's talk about this coming Friday. So we had CPI today. We'll probably see some after effects of that CPI print tomorrow, but today relatively muted response. Friday, we have something called quadruple witching. Now, if you're not familiar with that, this refers to expiry of 4 classes of derivatives. So we have single stock options, index options, single stock futures, and stock index futures, all expiring on Friday. And you'll see that referred to as OPEX, options expiry. Now, this is a big deal. It's not really a big deal in the longer term. It doesn't really make much difference if you zoom out and you're investing over the course of months and years. But it does make a big difference to the short-term levels of, in particular, the indices, particularly the Nasdaq and the S&P, and any stocks that hang off of the back of that. So at these times, it's really easy to get freaked out by the big swings that are moving around in particular the Nasdaq and the big stocks and the big participants in the S&P. And you'll see this volatility reported all over CNBC, Twitter, everywhere else, and you'll see basically everyone from big money down amping up this volatility, and it's very easy to get freaked out by it. The way to not get freaked out by it is to understand it. And it's a great long topic. We'll get into another time, but just very briefly, if this is new to you, the reason that options expiry matters, and in particular, the 4 quarterly expiries that happen through the year, March, June, September, December, is because of market maker hedging. And it works something like this. So if you are an investor, and let's say you are buying options, you're buying calls, you're buying puts, calls bullish, puts bearish, you are usually buying them one way or the other from a market maker, from an options dealer. Now, market makers don't make money based on the direction of the market. Their job is to make money on the bid-ask spread of the securities, the options that they sell. Now, to do that, they have to hedge. So if you, the investor, buy a call option, then the market maker has sold you a call option. You've bought a call, you're bullish. If they've sold you a call, they're bearish. Now, remember, they have to remain hedged. They have to remain something called delta neutral. The idea is whichever way the market goes, their portfolio does not move a dime. That's the idea. So to hedge, having sold you a call, remember, selling a call that makes them bearish. So they have to hedge by buying the underlying, be it a future or the stock or something else, but hedge out by taking a long position. If you've bought a put, you're bearish. They've sold you a put, they're bullish. They have to hedge that by going short the underlying, either short futures, or short the underlying stock. So let's get to options expiry. Let's say you own a call and the call expires Friday. And let's say that call, you either exercise it because it's in the money and you want to turn it into the underlying, or you sell it for a gain, or it's out of the money and you just let it expire. At the moment that option expires, then the dealer's book is no longer hedged. The dealer now has a directional exposure, and that's not their business at all. So what they have to do is unwind their own hedges. So think about this in the scintilla of time. Think about it at the closing of Friday. At that moment, a bunch of options expire. Remember, options don't trade outside of real-time trading hours. They only trade in market hours. They don't trade afterwards, unlike futures, unlike equities. So the options expire at the close of Friday. The dealer now has an unbalanced book and has to re-hedge. If the dealer has been selling calls, has been bearish, and they have hedged by going long the underlying, then the minute the option expires, they have a long exposure that they need to get rid of, and they do that by selling it. So if investors come into OPEX heavy on calls, very bullish, then the market makers, the dealers, when those bullish calls expire, they have to cancel out their hedges, and their hedges have been long. Remember, they've sold you a call, so they are bearish. They hedge that by being bullish. But once the bearish side of their book goes, they're left with a long side. They have to get rid of it. And so what you often see is that a very bullish options expiry period, and you'll know that because stocks run up into it, when that expires, you often get a rapid reversal, a rollover and a move to the downside. And that's caused by the re-hedging of dealer portfolios. And the converse is true. So if investors are very bearish into options expiry, remember the dealers have sold those puts, they're bullish. To hedge, they've taken bearish positions. Puts expire, the dealer is left holding a directional book, it's not their business, they have to get rid of it. They have to cover their short positions, and that can lead to a bullish move upwards. And so in short, you tend to get a reversal at options expiry days, particularly at the quarters. And if the market has been very directional into expiry, if the market's run up really hot into expiry, that typically means investors are long calls. And therefore, when the long hedges are sold, you see a move sharply to the downside. If investors are bearish, really bearish into an options expiry, when the hedges are unwound, the market can reverse to the upside as dealers sell their hedges. Now, to give you a couple of examples of this, let's go back to that same Nasdaq chart. So 1 second. Okay, here are some big options reversal periods. Okay, Q2, I should say Q1 options expiry in 2020 down here. Investors were incredibly bearish, as you can imagine, going into Q1 options expiry. Why? Because the COVID crisis had just hit, and no one knew quite what was going to happen. And so there had been a whole lot of selling of equities and buying of puts. And the reversal down here was catalyzed because the options expiry in that Q1 period, once the options expired, there were lots of puts had been bought. So dealers had sold puts. Investors were bearish. They bought puts. Dealers sold puts. They were bullish. They had to hedge that bullish exposure with short underlying. Options expire. Dealer is left holding a whole bunch of short positions. Dealers have to cover to get rid of the shorts, and the market starts to move up. And then in comes the flood of federal liquidity, and you get a rush upwards. So the catalyst or the accelerant was options expiry, and the sustained fuel was federal liquidity. Now, at the end of 2021, the exact opposite happened. So everyone thinks the market's going to go up forever because that's what always happens in bull markets. Investors were heavy on the calls going into December OPEX. Remember, it's a quarterly OPEX, a lot of capital involved. The capital in the derivatives market far outweighs capital in the equities market. So when big things happen in derivatives, it does tend to yank the equities market around for a period of time. Investors very, very bullish into Q4 2021. Dealers have sold those calls. So the dealers in selling a call are bearish. They've had to hedge by taking long positions. The options expire. The short side of the dealer book has evaporated. They have to sell the long side, and that sparks a sell-off in equities. And again, that's now that's the catalyst accelerant. And the sustained fuel then comes from the tightening of monetary policy. So this is Q4 OPEX up here, 2021. This is Q1 OPEX 2020 down here. And these were very extreme events. But you can see something similar in Q1 2009. So coming into the teeth of the great financial crisis, very, very similar to early 2020. Investors very, very bearish, bought lots of puts, once those puts expired, dealers had to cover the shorts, and up comes the market, and then here comes the federal liquidity, and whang, 2009, very bullish year in the end. So options expiry is Friday. How you'll see this play out is usually, not always, sometimes it's smooth sailing, but usually you will see a flurry of activity on Friday, usually towards the end of the day as options start to be exercised for those that are in the money and they're owned by people who want to translate them into the underlying, or sold for profit. And then as they start to actually expire, you'll see dealers start to rebalance through Friday. And you can see it as the market starts to move. And then Monday, Tuesday, you can see an echo of that. So volatility that you see Friday, Monday, Tuesday can be many things, of course, but that options expiry is likely to play a big part in that. Now, in some of our other services, we cover option positioning going into that. So we'll report in those services about whether investors are call heavy or put heavy. But what thing you should look for is volatility going into Friday. If you are a long-term investor, if you are focused on what's going to happen, next year and in 10 years' time, options expiry should be treated as something along the way. And what you ought to be doing is watching all the furore that's on television and on Twitter and everywhere else and everybody's Substack. And if you understand the reason for that short-term volatility and you've done the work on investors are call heavy or put heavy and therefore the market should do this or that, you can have some sense of, is this something I need to worry about or not? Sometimes it is, for example, these big reversal points, but sometimes, June OPEX really passed without too much events. In truth, there was not a huge amount of volatility caused by it. The market just kept going on up anyway. And so you can judge whether it's something you need to worry about or not. If you trade short term, you really need to understand options expiry and what it can do to the instruments you trade. Okay, before we move on, I'm going to do some single stock stuff. Any further questions, points, anything at all that anyone has? If so, either unmute yourself and shout into the system, or you can type questions into the system here, or you can use the chat function. Failing that, let's move on. So let's go back to our presentation for a moment here. Okay. Let's talk about three growth stocks that didn't really get the memo in 2023. They're all up for sure, but they are up small compared to where we think they can go. So the three I want to talk about are Cloudflare, Zscaler, and Qualcomm. Now, these names will be familiar to many of you. Cloudflare is an internet services business. It started off doing content acceleration, moved into distributed application development and application acceleration, and then moved into security perimeter provision. Zscaler is a pure player in cybersecurity. You'll be familiar with the concept of zero trust networks, and that's usually synonymous with Zscaler's offering. Qualcomm, as you know, semiconductor IP business, predominantly known for inventing CDMA a long time ago, basis in most mobile networks now, and now a big supplier in most RF markets. So let's have a quick look at each of these and see where they are. So let's look at Cloudflare first, and let's look at the Cloudflare chart to begin with. Okay, so let's get Cloudflare up here. Okay, now we use the same Fibonacci Elliott wave charting method for our single stocks that we do for our index work. And here's how it's worked pretty nicely so far for Cloudflare. So starting back in February 2020, Cloudflare puts in a 1, 2, 3, 4, 5 waves up, a huge move up from early 2020 when the stock was around $15, $16 to a high of 222, in the course of only 2 years. Now, that's not uncommon for super volatile stocks like this. Nvidia has done something similar a couple of times now, and many other tech stocks will do this. And the reason is that, as you know, they're high growth for sure. Investors get all excited about it, get ahead of themselves a bit, and then something changes in the market. In this case, rates, the cost of money, and then all of a sudden people lose their appetite for risk. You very often as well see that the volumes in these big spike upwards are not that high. Very often when you see the price move up here, this isn't often really big money buying here. Usually this is either momentum funds or retail. And that's no different to here. So if you look at the volume by price here on Cloudflare and you were to set the start of the clock back at early 2020, you can see that, well, the bulk of the volume is traded, below, let's call it $88 a share. And up here, these gray bars here represent volume at each particular price slice. There really isn't a lot. In fact, over, let's call it 136 a share, it's hardly any volume. So anyone who was buying, or frankly selling Cloudflare up here was in a pretty lonely room. And so that tells you that was mostly retail, maybe one or two small funds, but mostly retail. Now, big money being smarter than retail, that's why it's big money, did this. It just waited and waited and waited. And so a good chart method for these relatively recent IPOs is to set your Fibonacci ladder starting at 0. Obviously, the stock has never traded at 0. Hopefully, it won't ever trade at 0, but this is just a modeling artifact. And you measure the move up from a notional 0 to that wave 1 high, which is a completion of a 5-wave cycle back to that fractal point I referred to earlier. So we're up to 222 a share here. What you often see with these high growth stocks, and you can see it time and again in many, many stocks that peaked like this in 2021, is a drop to around the 78.6 retrace of that move up. And Cloudflare actually goes a little bit below that. So it's a real big sell-off down to lower than the 78.6 retrace of a move up from a notional 0 to that all-time high at 222. And it just moved sideways from around May last year. And a lot of tech stocks did this. If you ask people what they feel happened in 2022, they'll tell you that it was a disaster area all year. Well, it wasn't really. If you look at the matter of fact, what happened was a lot of stocks and indices traded sideways in a range from around May that year. People thought that in the middle of the year, August in particular, the market reversed and we were on the way back up again, and that didn't happen. It was a further sell-off. But again, if you just zoom out, then this stock, as so many others, was just range bound, and it was range bound between around 38 on the low end, and for the most part around 65 on the high end. It just moved sideways. Now, in our work, we tend to use ranges, price ranges, to call accumulation, buy, and markup, hold, and distribution, sell. Ranges, why? Because that's how large account players work. You won't find anyone at a huge insurance company running out to buy their whole position in Cloudflare on day one, and you certainly won't find them buying huge amounts up here at the highs. That's why volume's so low. You will find them studying these high growth companies and working out which ones they think are going to be persistent winners and waiting for these sell-offs in order to build positions slowly. And that's why we call this accumulation. What we try to do in all of our work is we try to find ways to follow the breadcrumbs of what big money is doing and help our subscribers follow suit just a little bit behind. You don't want to get in front of big money, you could be trampled, but if you follow behind, you can try and see what they're doing and follow suit. Cloudflare continues to move sideways. It's now up at the top of this accumulation zone, not the bottom, but it hasn't really broken out of that zone convincingly. A couple of spikes up, but not really has it broken out of that zone since May last year. Fundamentals, though, have improved a lot. And we've already seen that the macro backdrop, inflation rates, Nasdaq direction, all of that is looking pretty good. So we think that Cloudflare can move up quite nicely. Now, for disclosure, I have a personal account position, long position in Cloudflare. It's a stock that I personally hold and expect to go up. So just so everyone's clear. But if we were to look now at Cloudflare fundamentals, which we'll put on screen right now, this is what the company looks like. So it's not the world's biggest business, but neither is it small. About $1 billion of annual revenue now, and growth has held up reasonably well through 2022. You've seen a lot of companies slow to a crawl. Microsoft, I mentioned earlier, I think in the December quarter, if I recall correctly, put in a 2% growth rate. Cloudflare was growing in the 50% range in 2021, and that slowed now down at the most recent quarter reported June down to a 32% year on year in the quarter. So, 32%, looks bad compared to 54, and it's obviously a lot lower, but that's a pretty decent rate of growth. Trailing 12-month growth just under 40% on a $1.1 billion revenue base. So that's okay. High gross margin, 76%, not too much in the way of payaways here. Where Cloudflare is kind of frustrating is in cash flow. So on accounting margins, they're trailing 12-month EBITDA margins. So that's basically revenue minus variable costs minus operating costs, add back depreciation, non-cash item, add back stock-based compensation, non-cash item, trying to make an approximation of cash profit here before CapEx, 14% margins. And you can see that it's managed to EBITDA margins really carefully. You know, the thing has stepped up a couple of points every single quarter since 2018. So this is an optic that obviously matters to the company. Cash flow is improving but remains negative on a TTM basis, which is, you know, frustrating as a shareholder here. And the reason it's negative is because CapEx is substantial. They have to buy a lot of hardware servers to go in third-party data centers. They have to put those applications and content and security perimeters somewhere, and that has to live on something, and that something is hardware. CapEx is big here, you know, 14% of revenue on a trailing 12-month basis right now. The thing they're not very good at, frankly, is collecting cash. They've referred to this themselves in some of their earnings calls lately. So they don't really have an upfront billing model. Plenty of companies in this world do. And Cloudflare's leverage over its customers is substantial. You're a Cloudflare customer, and you don't want to move from their platform soon. They do a good job, and moving is a brain ache, and you don't want the problems with your site, your applications. You certainly don't want the problems if you use them for security. So in our belief, they could apply a little bit more pressure and charge more upfront to customers. They intimated on their calls they may do that, but they've yet to really see that come through in the numbers. So they leak money from working capital. They pay people faster than they get cash in the door, which is not ideal. So trading 12-month unlevered pre-tax free cash flow, minus 5%. It is improving, as you can see. It troughed out at negative 20% in March 22 quarter, and it's improving. That probably will turn positive at some point in the next 2-3 quarters. Balance sheet is okay. The net cash number looks poor at only $270 million, but that's because of a big convertible, $1.3 billion worth of convertible loans now. But actually, the liquid cash and short-term investments number is, you know, over $1.5 billion. So actually, they have the cash to do what they need to. Deferred revenue and remaining performance obligation, RPO, if you're not familiar, is the totality of the customer order book. So this is orders that customers have signed and committed to, purchase orders signed basically. And it's a big order book at Cloudflare. It's $1 billion right now, and that amounts to about 90% of trailing 12-month revenue. So it's a big number relative to revenue. And it's also growing at a rate similar to revenue, growing at about 30-odd% a year. So the order book's going up reasonably well. Deferred revenue, which is that's the amount of the order book that has been invoiced. Customers have accepted the invoice. That either sits as a receivable or cash on Cloudflare's balance sheet. Is also reasonably in reasonable good shape. It's growing quite quickly, which is good. So we're up 76% on the deferred compared to last year. But unfortunately, to the point I made a moment ago, that the amount of money that's prepaid is pretty low. It's only a quarter of trailing 12-month revenue. If you were to look at this for a Palo Alto Networks or Fortinet, you would see it as an amount 2 times last year's revenue because they bill so much up front. Cloudflare needs to get better on this. Now, they know this. They're working on it. So fundamentals are, I would say, good, not great, but good. But this is a company I think that's going to be of increasing importance. They are a second-tier player, I think it's fair to say, in zero trust security, but they're now federally certified to sell into government departments. They are relatively low cost, and they offer a suite of things, which is always easier for an enterprise or a government client to buy than a pure play. So if we look back at our chart here, we're pretty bullish on Cloudflare. We think that once it breaks into this markup zone, and we think it will, it can move up quickly. And the reason for that is back to this volume chart over here. There are not too many bag holders in size of Cloudflare over about $87 a share. So if it can push up to $80 odd a share, there's not much resistance ahead. Resistance comes from supply of shares for sale. If you have lots of people wanting to sell the shares, obviously that's resistance. But not that many people own shares from up here. If you were to start by the way, the volume clock at the all-times high, you can see this huge accumulation down here, these big grey bars down here. This is almost certainly institutional accumulation down here. So we expect to see a push up in Cloudflare stock before too long. Now, clearly, if anything goes badly wrong with the market, if the Nasdaq blows up, so too will Cloudflare. But if the Nasdaq does anything like the things we talked about today, we think Cloudflare can do well. Okay, so next stock. We said that we thought Zscaler also could make a move. Now, Zscaler, from its trough this year, has doubled or thereabouts. This is a stock that we're very loudly calling accumulate on down here at the lows. And if you were buying down here, it troughed at around 80 something, I think, yeah, 85. And right now it's around 155, and it's been as high as 168 during the course of the last week or so. Zscaler is a really superb business on fundamentals. It's the leader in zero trust security networking. They are very much in vogue amongst federal government departments, amongst the highest end of enterprise customers, great reputation for what they do. And in our book, cybersecurity is only going to get more important. The fundamentals, which we can look at right now, are really superb at Zscaler. It's an exceptionally well-managed company on the financial front. So we're just going to zoom in here. Revenue base, about a $1.6 billion trailing 12 months revenue. It's growing at 48%, so significantly faster than Cloudflare. EBITDA margins around 16%, cash flow margin positive 10%, and it's been cash generative for a very long time now. This thing does not eat money at all. It generates cash every single quarter. We talked about the size of the order book, remaining performance obligation here. The order book at Zscaler is more than twice the last 12 months revenue. So that's a big fat order book they have. And of that, a really big chunk of it is prepaid. So deferred revenue, that's invoices that have been accepted and sit in either receivables or cash, 90% of trailing 12-month revenue. So this tells you that the company has plenty of leverage over its customers. It can bill up front for many, many things. And the deferred revenue growth, 41% a year, order books growing at 35% a year, really strong business. Let's look at the chart once more. So we believe that Zscaler started its cycle at the COVID lows for all the reasons we discussed earlier. We think it's a wave one up. So Zscaler, another highly volatile stock, troughed out around $36 a share in the COVID lows and moved up to $377 a share, not 2 years later. So there's a 10x your money in the space of less than 2 years. And if you think, those days are gone, they're not. NVIDIA did this over that period of time, dumped all the way through 2022 and has replicated that huge performance on the way up again already this year. Volatile stocks are volatile on the way up, volatile on the way down, and they'll be volatile on the way back up again. Zscaler has, in our view, particularly good fundamentals, not just its own company matters, but the whole cybersecurity space we think is only just going to be in more demand. And again, if we have our macro backdrop right and the Nasdaq backdrop right, we think this thing can really move up. Again, for disclosure, a personal long position in Zscaler. The stock I own, I'm hoping it goes up. But this is our analysis. This thing can, we believe, put in a wave 3 up here. And a wave 3, as we mentioned earlier, can and often does peak somewhere in the range of the 1.618 extension of the prior wave 1, which in this case will be in the $600. Now that looks, a crazy number from a stock that can't break 160 very convincingly right now. But again, this is what high beta stocks do. They overreact to the upside and they overreact to the downside. So yeah, this might not happen. This might just be a complete fantasy. But if we have our work right, if that Nasdaq moves up like we think, if the economy stays strong, if rates come down, if inflation stays suppressed, this isn't a silly number. And if you think it is a silly number, well, we called for a similar expansion in NVIDIA when it was in the $100 to $150 range, which is we published all over the internet, and you know what's happened there. So this kind of thing happens more than you think if you're watching out for the right stocks. So that's Zscaler. Finally, we'll finish off with Qualcomm, a much older business. So let's again look at the chart first. Now, Qualcomm is a business that's been around for a very long time. We have a long run chart right here. Again, this is a leading comm semiconductor business. It sells predominantly in the form of intellectual property designs. And we track the stock up from, in this case, 2019 lows. And the chart respects this wave and Fibonacci method quite nicely. So we saw a 1, 2, 3, 4, 5 wave ups from 2019 lows to the 2020, just right at the start of 2022, it peaked. So from around $49 a share down there to about 200 up here. So in the course of, again, a little bit over, I guess it was 3 years, 4 times your money in 3 years, pretty good in a common stock. We then see, I mentioned earlier, you often get these corrections. You get 5 wave up in the dominant move up in a bull market, and a 3 wave correction in a bull market. So A, B, C correction on the way down. And again, look what the stock does from around you see August last year. It starts to trend sideways, a little bit of break to the bottom, break to the top, but just sideways really. And in Qualcomm's case, that was for the same reason that the Nasdaq and the S&P traded sideways, which is in essence that big money was starting to accumulate. Was still very happily scaring the civilians on CNBC and Twitter and everything else, but big money itself was starting to buy. Again, you can see that from the volume chart right there. But in Qualcomm's case as well, there's some uncertainty around their business with Apple, which is a huge client for them. Apple, as I'm sure you know, was in the business of designing its own RF modems. They've had to put that back somewhat, and they've had to recontract, it seems, with Qualcomm for, if I recall correctly, another 3 years beyond what they expected to do. And that will put a spring in the step of the fundamentals and therefore the stock, I think. Qualcomm fundamentals on the chart here. This does not look at all like one of these recurring revenue software businesses. It's a very volatile revenue line. Cash is all over the place, profits all over the place. That's normal in semiconductor. The trends have not been good of late. You can see that this company that was growing fully 1% a year in the March 22 quarter was down to negative 23% growth in the June quarter. And that's not just the Apple roll-off, but that's part of it. EBITDA margins stay pretty good, 37% margins, 23% cash flow margins. This is a very well-established business that is very mature business with a big moat around their RF technology. So even if growth goes into decline, the thing will still churn out a fair old bit of cash. Balance sheet, slightly levered now, but nothing to worry about. It's just under $7 billion of net debt, which sounds a lot. But if you think that, the last 12 months EBITDA was $14 billion, and 0.5 times leverage is not, a big deal. With any semiconductor business, and this is no exception, there's usually not much in the way of order book or prepayments, much more contingent model, which is why the stocks are so volatile. So you could think of this as growth's been really difficult at Qualcomm. Profits and cash flow have held up okay, but growth's been tough. The Apple news is really important, and we think it can help turn the stock around. And so, again, if we look at where this could get to, then we think I'd hesitate to call a huge wave 3 on this one because we just don't know what's going to happen with Apple. But we do think that the stock can start to move up and out of this accumulation zone. We define that as between about $107 a share, about $123 a share, which is defined by the 2 Fibonacci levels that it fell to here. So we think it can certainly start to move up to 140, maybe 160 without too much stress. And then let's see what happens to the fundamentals. So at 112 right now, we think there's a good, maybe 50% upside to be had if all the things that happen in the market that we talked about. And then we'll see what happens with Qualcomm's fundamentals. So 3 stocks that we think that can still break out, that still have the potential to move up despite this very strong market in 2023 for growth names. That's Cloudflare, NET, Zscaler, ZS, and Qualcomm QCOM. Again, for disclosure, I own shares in Cloudflare, NET, and Zscaler, ZS. I do not own a position in Qualcomm. I may do in the future, but I don't own one at the moment. That's it, folks. That's all we hope to cover for today. So we're smack bang on the hour. So if we have any questions whatsoever, now is a great time to do it. I'm just going to flip back to the presentation for one moment. There we go. And if you'd like to sign up for our Substacks, we offer a couple. You can sign up for free. You can take the paid or the pro versions, but free is pretty good. This is the Tech Select service, so sestriantechselect.substack.com, or you can get there from our website. We also run a generalized market index and sector ETF Substack called Market Insight. Again, you can find that from our website. We'd be delighted to have you along as a free or a paying subscriber. Any questions at all, you can reach us in Substack notes, or you can email us using the email that's on the page right here, or you can post comments to the recording of this. It'll be on YouTube shortly, and we'll come back to you. Thanks everyone for joining today. Hope you've enjoyed the session and found it useful, and look forward to seeing you in our Substacks very soon. Thanks, folks.